Assalamu alaikum and hello everybody. My name is Zishan Hassan. I'm the tutor of finance reporting, previously known as F7. Um, I'm been teaching this paper since last more than 13 years now, and various of my students got worldwide and country-wise positions in this paper as well. Well, in this session, we'll be doing the past papers of September and December, sampled September-December 2021 exams, right? So straight away, without wasting time, let's move on. Here it is, moving to the first scenario. As you can see, the scenario is related to three requirements. The following is extract from the trial balance of Means Company for the year ended 31st December 2005. Uh, Note revenue 24,300, cost of sales we have 11,600, admin expensive 10,900, distribution cost 7,300. Okay, income tax, note 3, 140, deferred tax liability, note 3, 7,700. Okay, provision at 1st January X5, 4,600. Uh, relate retain earnings 43,200. Okay, equity capital 60,000. Intangible assets 3,300. Investment property 19,000. I'm reading reading millions into thousands. Okay, so finance cost 1,409, 1,400. Sorry, investment income 500. Suspense account is 46,500. Okay, then before reading these adjustments, let's look at the requirements. The three requirements. What are those? Prepare the statement of profit or loss for the memes company for the year ended 31st December X5. 12 marks. Good enough. Prepare the statement of changes in equity for the memes company for the year ended 31st December X5. Okay. And prepare the following extracts from the statement of cash flow for memes company for the year ended 31st December X6. Cash flow from investing activities, cash flow from financing activities. 5 and 3 marks. Fair enough. Let's move on and look at the adjustments now. Memes company noted there was an error in the inventory count at 31st December 2004, meaning that the closing inventory balance in X4 financial statement was overstated by zero point 0.7 million. So no entries have yet been made to correct this error. Well, the closing inventory balance in the financial statement was overstated by uh, zero point 0.7 million. No entries have yet been made by. So what we will do for this, cost of sale, debit, inventory credit, simple and easy. Now, the provision related to the court case in existence since December X4. Memes company settled this case on 31st December X5 for 6 million. The full amount was credited directly to cash, but double entry, corresponding debit entry being made in the suspense account. Okay, so what we will do? 6 million, right? The full amount was credited directly to the cash with a corresponding debit entry being made in the debit account. So we have to finish this. So what we will do? Suspense account debit by 6 million. That means 6,000. I'm writing over here. And uh, cash credit 6,000. And that will be related to provision of this. Now, the income tax figure, the court case. Okay, the income tax figure in that trial balance related to the under or over provision from the previous year. The current tax year is estimated to be 1.2 million. Addition to this, the deferred tax liability at 31st December excess is estimated to be 8.2 million. Okay, so let us go up once again. Uh, Income tax 140 and deferred tax. So it is 7,700. Over here, we will add deferred tax 8.27, 500 more into it. Let's move on. The on 30th September, Exxon Memes Company made a 144 right issue. The excise price of 3.5 per share. The proceeds were correctly accounted for cash with the corresponding credit entry being made in the suspense account. Why so? I didn't get that. Why they did that? Okay. uh, share capital 60,000. So, okay, I need a calculator for this. So, 60,000 divided by 4 will get 15,000 more shares. And right, right issue is for 3.5. So, 15,000 into 3.5, 50 to 500. Well, we will incorporate it when time comes. Finally, uh, Memes company incurred a number of expenses in relation to, no, sorry, Memes company acquired an investment property for 20 million cash on 1st January X5 and decided to use the fair value model to account for investment properties as the investment property is expected to have 20 year useful life. Depreciation was recording on this basis. The value of the property at 31st December X5 has been assessed to 22 million, but no accounting has taken place relation to this. All depreciation and amortization is charged on a pro rata basis to admin expenses. There were no other acquisition or disposal of non-current assets. So they acquired, Memes company acquired 20 million. Okay, so investment property debit cash credit 20 million, then decided to use the Fairview model for the investment properties. So, as the property expected to have a 20-year useful life, depreciation was recorded on this basis. The fair value of the property has been assessed as so the value has increased. So, property debit, P&L credit, the gain will be in the over here. So there was no other acquisition or disposals. Meme companies incurred a number of expenses in relation to brand the year and capitalize the following costs as follows. 1.3 million cash was paid on 1st April, promote one of its major brand, which is to have an indefinite life. Okay, 2K million cash was paid on 1st October to acquire a brand from one of its competitors. Memes company expect the brand to have a useful life of 5 years. Memes company intend to sell it, and after 5 years at the point of sale, it is estimated that value of the brand will have increased, and so amortization has been accounted for. Okay, Memes company paid a dividend of zero point 0.4 per share on all existing shares, recording the dividend paid in admin expenses. Well done. Now let us prepare our firstly, as you can see, Memes Company statement of profit or loss for the year ended 31st December 2000 X5 revenue straight away from the trial balance. Copy paste 24,300. Now cost of sales. Uh, Given cost of sales in the trial balance, as you can see, 11,600 minus the overstated inventory. So we'll get 10,900. In a result, we got GP 13,400. Admin expenses from 10,900 plus 1,400 related to the provision. Remember that? Now, which was not recorded, plus 1,300 brand promotion, promoting brand. We just read the adjustment, plus 100 related to the amortization of the brand, minus 4,000 uh, of property development, plus 3,000 of dividend paid, which I was okay. The total 7,300. Oh, sorry, plus 300. So what will be our total admin expenses? The total admin expenses are 9,700. Okay. So total admin expenses are 9,700. Then a distribution cost 1,700. Copy paste from the scenario. Copy paste from the scenario. Okay. So far so good. Now, um, then after distribution cost, we will get loss from operations 3,600, negative 3,600, loss from operations. Finance cost minus 1,400. Okay, given in the trial balance. No, investment income 500 plus 2,000 of investment property gain. So total is 2,500. 500 we got from trial balance. Loss before taxation is 2,500. Now the taxation 140 minus 1,200 given in the uh, adjustment 500 of deferred tax. We just did the working, rough working. So it's 560. Loss for the year 1,940. I hope you got the uh, statement of profit or loss. Then statement in changes in equity. Three headings: share capital, share premium, and retain earning, because these are the three things which we found in the trial balance. Now, at 1st January, balance at 1st January 2005, 60,000 share capital, whereas we have nothing in share premium, and retain earning was 43,200. Okay. So prior period errors, there was no private period errors in share capital and share premium, but 700 related to inventory, we will deduct it here. Okay. Then restated balance and 1st January X5, 60,000 nil and 42,500. Okay. Moving back, share issue, uh, none, share premium none, and 1,940 from the retain earning related to the side issues. Okay. Dividend paid. We have total 75,000 shares now into 0.04 the dividend rate. Okay. So 3,000 negative. Closing balance will be 75,037,500 and 37,560. Now, extract from statement of cash flows for year ended 31st December. Cash flow from investing activities: purchase of brand 2,000, purchase of investment property 20,000. Okay. Net cash using investing activities, very simple, 22,000. Cash flow from financing activities: proceed from issue of share capital 52,500, dividend paid 3,000 negative, but will get net cash from financing activities 42,500. So far so good. Moving here to the next scenario. The scenario relates to your four requirements. Okay, the Pinardi Groups operates in the fragrance and cosmetics industry. Let us look at the requirements first. Okay, now moving down. Calculate the gain on disposal of silver company that would need to be included in the consolidated statement of profit or loss for the Pinardi Group for the year ended 31st December X7. First requirement, 2 marks. Explain whether or not the disposal of silver company is likely to do constitute a discontinued operation and correct accounting treatment for this, 3 marks. Calculate the following ratios for the predetermined formatted table for the Pinardi Group X7, X6, GP margin, operating profit margin, interest cover, and inventory turnover days. Finally, analyze the performance and position of the Pinardi Group for the year ended 31st December compared to the year ended December X8, X6, 11 marks. Okay, that's it. Now, let us look at the scenario. This scenario relates to 4 requirements. We just look at that. Nothing new. The Pinardi Group operates in the fragrance and cosmetic industry. On 1st January X7, Pinardi disposed of one of its subsidiaries, Silver Company, for the cash of 42 million. Silver Company manufactured jewelry and was sold because the Pinardi Group wanted to exit this particular sector. Extract from the consolidated financial statement from the Pinardi Group. The year ended 31st December X6 and X7 are as follows. Revenue in X7 98,300, X6 122 400, cost of sales 47 600 and 71 800, GP margin 57 50,700 and 50,600. Yeah. Operating expenses 33 700 and 37 400. Operating profit from operations 17,000 and 13,200. Finance cost 3,200 and 5,500. Profit before tax 13,800 and 7,700. So statement of financial position, inventories 13,300 and 22,400. Cash 31,400 and 14,600. Non-current liabilities 42,000 and 61,000. Now, what saying the accounting assistant has not accounted for Silver Company as a discontinued operation because the disposal occurred on 1st January X7. Uh, no figures from Silver Company has been included in X7 financial statement except the proceeds from the disposal have been recorded in cash with all nets and goodwill. He recognized the balancing figure was held in a suspense account. Pinardi Company acquired 100% of Silver Company on 1st January X1 and goodwill was calculated as 6 million. The goodwill had been impaired by 30% in X5. The net assets at 1st January X7 were 35 million. As part of the sale agreement, the Pinardi Group will receive an annual fee of 2 million for the use of the Silver Company brand. X7 annual fee has been included in the Pinardi Group revenue for the year ended 31st December X7. The results obtained from Silver Company individual published financial statement shows following key information. Revenue 39,000 and 36,000, gross profit 18,000 and 12,600, profit from operation 8,000 and 6,000. Prior to disposal, Silver Company used some property belonging to the group. Following the disposal, Pinardi Group moved its cosmetic division into the property. Previously, cosmetic division had leased external facilities for 2.5 million a year. At 1st January X7, the lease had 10 years remaining to exit. The lease Pinati Group made a one-off payment of 3 million to the lessor and recorded as operating expense. Pinati Group acquires raw materials from the overseas in X6. The group recorded foreign exchange gains of 3 million and in X7 the group made a foreign exchange loss of 1 million. Both items were recognized within operating expenses. So far, so good. Now let us resolve it. Well, disposal proceed as mentioned into the scenario 42,000. Net assets at disposal, we just look at 35,000. Okay. Uh, Less goodwill at disposal. Here is the working. Goodwill at acquisition mentioned into the scenario 6,000 less impairment. 6,000 into 30%. Unrecognized goodwill at disposal, it's sorry, impairment 1,800. Unrecognized goodwill at disposal 4,200. So from there we got it. So far so good. So goodwill on disposal will be 2,800. Sorry, gain on disposal will be 2,800. I'm sorry. So now explanation of silver company disposal. Silver company is likely to meet the criteria as it is a major line of operations which has been disposed of during the year as a division operations. The present would be borrowed and the parent would be remained and presented separately on the face of the statement of profit or loss together with the gain on disposal of 2.8 million. As silver company was sold on 1st January X7, there was no result. Uh, for the current year, however, the result of X6 should be shown as a discontinued operation for a comparative purpose. Now let's do the ratio calculations over here. Gross profit margin. We just saw this. Uh, 50,700 GP divided by revenue 98,300 multiplied by 100 will get 51.6%. Okay, for X7. Um, Operating profit margin 17,000 divided by 98,300 into 100 will get 17.3%. Interest cover. Interest 17,000 divided by 3,200 PBIT 5.3 times. Inventory turnover days 13,300 divided by cost of sales 147,600 into 365 will get 102 days in the same way using the same formulas. 50,600 divided by 122,400 multiplied by 141.3%. 13,200 divided by 122,400 into 100, 10.8%. 13,200 divided by 500 PBIT 2.4 times. And 22,400 divided by 7,100 into 365 114 days. Now let's do the analysis. The overall revenue is down by 24 million, which may be largely due to the disposal of silver company, which is in the 2000X6 results, but contributed to revenue in 2000, but no contribution in X7. So last year, silver company estimated, contributed 36 million in revenue. Re- okay, remaining this from the 2000X6 result. From that, it has been like from like increase of 1.2 million minus 36 million minus 98 to 11.9 million from fragrance and contributions. Cosmetics division. The GP margin is significantly uh, up from X6, the X7 4% to 5.2%. We can see that gross profit margin of silver company in X6 was only 35%. So the other parts of the group were able to generate higher gross profit margin historically. The operating margin has increased, although not quite as dramatically as the increase in gross profit margin. In fact, the operating uh, expenses has only decreased by 33.7 million despite 2.24.1 million decrease in revenue. There are some factors to consider. Exit fee of 3 million for cosmetic division to exit lease. While this is expensive, the division would have paying 25 million in 10 years, and so will ultimately some significant amount of money. Further, the effect of foreign exchange gain or losses are included in foreign operating expenses line. In 2006, there was a gain of 32 million, but in 2006, there was a loss of 1 million, which will have reduced operating profit. This shows that the Pinardi Group have quite large exposure to foreign currency risk. The interest cover have increased from 2.4 to 5.3 during the year, which is which is combination of both, uh, an increase in operating profit and decrease in finance costs. The finance costs are likely to decrease due to exit from lease. Okay, now what's the current position? The decrease in non-current liability is likely to be partly due to removal of the lease liability of the cosmetic division, uh, which had 10 years remaining. Some of the non-current liability may also have been paid off from the proceed from the sale of Silver Company. Silver Company was sold for 42 million, but cash was increased from 17 million. Therefore, Pinardi Group may have used some of cash to reduce the non-current liability in the group. So, Silver Company does not generate profits. The disposal seems to have been a good move. Silver Company results have actually improved since disposal, showing it is not struggling business. So that's it for this past paper. I hope you got it. The technique uh, use separate space by leaving some offline for the working, as we did in the first scenario, the working. Otherwise, nothing. Uh, Everything else, solve the workings, make the entries, then connected it to the scenario. And for this part, for the ratios part, what I did, no rocket science. Just I was moving line by line and interpreting it. Explain the scenario, either it is deteriorating or improving, then connect it to the scenario and give your reason. That's what I did. I hope this past paper session is helpful for you all. Uh, you can, if you have any questions, you can ask me. Till then, take care. Bye bye.